is struggling for some reason. This is a very popular topic right now, subject to financing. And essentially what this means is your buyer is purchasing the house at the price agreed on with all terms and things you guys talk about. Did you lose it? Let's see if it comes back on. Do you still see my screen?
Yeah, I can still see it.
Okay. I don't know what happened with my anyways. All right. So subject to. So your seller can offer this, your buyer can use this. Essentially what this means is the purchase, whatever those terms are subject to the buyer assuming and paying the seller's current mortgage. So as an example, you have a house that's listed for 800 grand and that seller has, let's say they have a $700,000 loan, but that rate is 4.5%, maybe lower. Your buyer, if they agree, could assume making payments on that exact mortgage, nothing happens, and they take that, they pay that rate, they pay that current thing. Most likely they're going to pay the difference in cash, so they might have a larger down payment, but they could get into a situation where they have a less tedious qualifying situation for credit. Man, what is going on with me? I don't know, something's happening with my equipment if I'm going in and out.
Yeah, it's going out in and out a little bit, but the screen still is good.
Yeah. So where this can help, if someone's trying to squeeze a few more dollars out of the price, they might do this as a lower rate. We're also seeing assumable loans, which I didn't add here. But now the interesting thing about this seller, if they want to buy a house immediately, they're still going to have to add, and they want to use a traditional mortgage, they will have to still add this mortgage to their DTI. So that's a penalty on the seller side. Now, if they're being strategic with this subject to financing and everything's working, in 12 months of tracking of this other person making the payments to that mortgage, a savvy lender will be able to take that information and remove the DTI from the seller, even though the mortgage is still in their name, just by showing it's been routinely paid by a third party. Now, so there is a challenge here. You know, your buyer and seller, they have to get along. They're essentially going into business together. They're not just doing a transaction. This is ongoing. Generally, this might have, you know, for a buyer though, there's no reason to stop this because of the most likely it has a super low rate, and they might have to pay for refinancing or anything like that. But so as long as it's working, but if it does fall apart, say even in 10 years, that goes back onto the seller as a default. So a little bit scary. It's very interesting. It's a very hot topic right now. I am not a big fan of it, and maybe it's because I don't get paid, but that's fine. But it keeps it, you know, a lot of times our risk, lender, realtor, buyer, seller, all the risk sort of ends at close of escrow after recording. Something like this goes on for the life of the ownership. So that for me is you know, constant risk. Okay, second type thing I want to talk about, seller financing. So a little bit different than the subject to, but still kind of funded by the seller. So we'll go back and we'll say, okay, the same seller has his house for 800 grand. And he has, let's say he has the same 500K mortgage. But he sets up, and his mortgage payment, let's say it's mortgage payments $4,000. I don't know. It doesn't matter. But he could set up financing. He's got 300 grand in basically equity. He could ask a buyer to put down 200K up front, and then he finances the rest. The new buyer is paying the seller directly, probably $4,000 or $5,000, whatever they come up with, because it's a private deal. They can create anything they want. Now, the interest or the insurance and the property taxes are still being paid by the seller in this scenario. And so the buyer's actually not paying that. The other thing that the buyer's not getting in this scenario is credit, is good credit for paying this mortgage. It's just money going out. So that's a little bit of a negative on that on that buy side. With the seller financing though, these usually have like a 5-year term. So I've been involved in a couple of these recently. I have a pretty aggressive buyer, and she'll try and get a subpar interest rate. And she's been pretty aggressive. Like, we've been offered some stuff in the 4s and 5s, which has been pretty nice. She'll try and manipulate a small down payment, as small as she possibly can. Most of the time they've been bigger than she likes, but doable. So she'll put it under being like a 5% interest rate, $150,000 down, with the seller financing essentially the other, say, 400 or 500 grand, whatever the difference might be. But that's going to have it can be amortized over 30 years, creating a lower payment for your buyer, but it will be a term of 5 years. So you're essentially only paying that first 5 years of the 30-year amortized loan. And then you have a balloon payment, or basically the term is coming to an end. At that point in 5 years, you either refinance or you sell the property and pay everyone whatever they're equal. But two very unique ways to particularly buy something. Seller financing is not new. Sub 2 is not new. Assumable loans are not new. But all three of them become a lot more popular whenever rates get high, and they've gotten high fast. The main negative to these in general that could affect both people is, in either of these situations, especially if this one doesn't end up having enough money to pay off his loan and he's just collecting it, if there's a mortgage on either of these two purchases and the mortgage holder finds out that this deal has happened, because you would transfer title in both of these scenarios. In that situation, if they find out that the seller has the original mortgage holder has released the property to someone else in ownership on title, they can call that mortgage due immediately. And essentially the seller doesn't have any collateral to give to the bank. Give to the bank if they do call due. So it becomes very weird. I don't know how that plays out. I'm not a lawyer. I've never heard even a horror story in this situation, but I can't imagine it being good or handled quickly. I think it could be months of stress. So assumable loans, we'll just touch on those. VA does allow you to assume a loan. FHA also, so the two governments that we talk about a lot. The one hook with a assumable loan with VA is the veteran's eligibility to use his VA benefit does stay with that loan, so he won't be able to use that again. That's probably the biggest negative we hear a lot, but generally, unless the veteran is disabled in at least 10%, he has to pay a funding fee, which we talked about, and it gets bigger on the second and third purchases. So it's actually better off for cheaper potentially to just go with a conventional as long as the rates are close. FHA, you can assume the loan and there's no tie to the seller at all. You just assume it. But in both of those scenarios, while there are a few banks that I've heard of will take a second, most of the time you have to pay the gap as the down payment. So you have a $800,000 house with a $500,000 loan or current mortgage. You're going to assume it because it's a 3% interest rate. You're going to have to come up with that 300 grand between the mortgage amount and the purchase price, plus your closing costs. But if that works for you, you're going to get a super low rate. So that's all. That's three things that are going on right now, and it's a lot of it's just based on higher risk because people are trying to avoid these massive rates. Any pointers on this topic, Travis, from the broker side?
I've actually never completed an assumption. However, one of our agents just did.
Okay.
She did, and the thing with it is the seller has to be on board with this because when you're going through the assumption, it takes months to get these done. It's not like a 30-day escrow or even a 45-day escrow. This one took between 3 and 4 months. I'd have to ask her exactly how long it took, but I know it was probably at least 3 months for
Everyone
this whole thing to take place.
that I'm seeing
But
is getting one done is like,
is that far? It is
yeah,
3 months. Yeah.
yeah. And I
Um,
think the reason why, because there's no money in it. No one's really making any money.
yeah. So
And so they throw it on someone's desk, and when the guy gets to it, he gets to it. But if he's got something that could earn him money, even a small commission, there's a good chance that becomes priority.
yeah, and maybe I can get her on to just talk about kind of how the process went. But yeah, it was a VA, assumable loan. Um, the buyer, they did have to come in with the difference between, what was owed on the property, and the purchase price. But the buyer got like a 2.675 or something like that rate. So, I mean, it was pretty phenomenal for the buyer. And there was a lot of little snags and stuff that kind of happened, and we had to kind of just keep kind of nudging the buyer along as to what an excellent opportunity they were getting with this assumption. So they completed it. Everybody was happy. Yeah, it took 3 to 4 months to get it done, though. So
All right, cool.
cool.
Well, thanks for
So
having me. And,
yeah, it's good info. Glad the rates are kind of hanging in. We'll see how that shakes out. I know everybody's looking at the next Fed meeting to see how, if they cut the rate or not. I don't really know that they're going to. I think they do have a couple scheduled in or, potentially scheduled in for next year, though. So is that going to affect rates directly on mortgages? I think we'll start to see them subside, but it's not going to be anything instant, just like what we experienced this year. Every time they did a rate increase, it didn't mean that the rate went up 0.5%, but eventually it started going up. So I think we will
right.
start seeing a little bit of easing here. So hopefully that just continues.
Yeah, it's awesome. It's good.
All right, I'm going to share my screen. Hopefully, if I press this, can you still see my screen?
I don't know, man. My computer's doing weird stuff. I don't know what's going on.
It seems like you can.
Yeah, I can see it.
Okay, awesome. Okay, so this comes up at least a couple times a month. Had this come up actually even just last week, coaching one of our agents through, they're on the listing side, having some issues with the buyer, so on and so forth. So we'll go ahead and go over this. I think it's a good topic. Because this does come up sometimes where the seller just wants to be done with the buyer for whatever reason, but there is a process to doing this. And maybe you have a buyer's agent saying, no, you can't cancel on us. That is true and not true, depending on what has transpired up to that point. So let's go ahead and go through this. I'm going to move this guy down here. Okay. And please answer or ask questions in the chat if you have any questions as we go along. But I'll go ahead and get started. So what is the most important consideration for a seller in canceling a contract? So in canceling a contract, the most important consideration is for the seller and agent to act methodically and deliberately. The seller should be aiming for a proper legal cancellation, which will be difficult for a buyer to challenge. As a listing agent, it's important to keep calm and remain in control of the cancellation process. Rushing the process of cancellation will often lead to a defective or questionable cancellation. Keeping the seller informed about the process and the necessity to handle it properly will help to also keep them calm as well. Usually when you're getting to this point, yeah, maybe you have a heated seller and they're just like, well, I just want to cancel and this and that. And can they? Yeah, I mean, I guess if they want to send the cancellation over and have it be done, but that doesn't mean that it was a legal cancellation, and that can be challenged. So what are the reasons that a seller may cancel as stated in the RPA? So the RPA prescribes exactly 10 reasons why a seller may cancel. All of the reasons require some type of notice to be given to the buyer, and that's either going to be the notice to perform, which is form NBP, or it's going to be the demand to close escrow, which is going to be the DCE. Both of those are your CAR forms. Before a seller may issue a cancellation. So you need to have one of those two forms needs to be sent over to the buyer, and getting to that point where you can send those, you have to go through these 10 reasons, one of these 10 reasons. So here are the 10 reasons. The buyer fails to remove applicable contingencies. Buyer fails to deposit the earnest money deposit or increased deposit into escrow. Number 3, the funds for the earnest money deposit or increased deposit are not good when deposited, so they bounce a check or something. The buyer fails to deliver the pre-qualification letter. Buyer fails to deliver verification of down payment and closing costs. That's going to be your proof of funds. The seller has reasonably disapproved of the above mentioned verification. So if this pre-approval letter looks kind of sketchy, maybe, it doesn't look real. Same thing with the proof of funds. I've seen proof of funds come over where it's literally typed out. This person has, $50,000 in this account. That's not sufficient proof of funds. Buyer fails to return TDS, NHD, lead disclosures, or other disclosures if required. Buyer fails to sign a separate liquidated damages form for an increased deposit. Buyer fails to deliver a notice of FHA or VA costs or terms if there's an FHA or VA loan. And number 10, the buyer fails to close escrow on time. When this is the reason for the seller's cancellation, the contract requires that seller first deliver the DCE prior to cancellation, which is the demand to close escrow. So where can we find these provisions in the RPA? The cancellation provisions in the contract are in paragraphs 14C 1, 2, and 3. So here we're looking at 14C 1, 2, 3. This tells you exactly the seller's rights to cancel, which are basically the things I just covered. So if you're unfamiliar with it, I would take just a couple minutes to look through this on the RPA. Also, it is found in 14E, which is the notice to buyer or seller to perform. So this is, what happens when a notice to perform is sent by either a buyer or seller. And also in paragraph 14G of the RPA, which is the demand to close escrow. So these are, the three sections you probably want to get familiar with, so you can understand how the contract works. Aside from mutual agreement, are there other reasons seller may cancel the RPA? So other cancellation rights may be written into the contract. For example, the short sale addendum and the contingency for sale and purchase of other property both contain seller contingencies which would create additional cancellation rates for the seller. Beyond the reasons as specifically stated in the contract or addendums, there are many other reasons which might entitle a seller to cancel, including fraud, mistake, duress, undue influence, illegality, or any issue that undercuts the meeting of the minds. However, if a seller would like to cancel on a basis that is not explicitly stated in the contract or in a way that is outside the procedure of the contract, you're going to want to direct them to consult with their own attorney on how this may be done. Don't give legal advice on that kind of stuff. When we're talking about the 10 reasons, we can give advice on that. But if we're talking about other things, well, I think they did this, or I think this was fraudulent, or this or that, that's when you refer them to the attorney, or, call up the car attorneys as well. What is the procedure for canceling? So step one is check the time frame to see if the buyer has performed as required by the contract. Step two, make sure the seller has fulfilled all seller obligations. This is the one that gets snagged the most, especially when someone calls me and they say my seller wants to cancel. That is usually the first question out of my mouth is, have they fully performed? And what does that mean? Have they provided all of the seller disclosures? And when I say all of them, that includes the listing agent's avid. So everything needs to have been delivered to the buyer. In the contract, the default is 7 days that the seller has to provide these items unless it was modified. But that is always going to be my first question to you is, has the seller fully performed? Step three, notice a buyer to perform or demand to close must be correctly filled out, indicating that the buyer has failed to do, and the seller must sign it. Step four, notice buyer to perform or demand to close must be delivered to and personally received by the buyer's agent or the buyer, after which the listing agent should obtain some type of verification that it was in fact received. Step five is count the days. That's meaning from when you delivered the demand to close or the notice of buyer to perform. That has to season for 2 days. Step six, the day after the last day to perform, the seller may then sign and deliver a cancellation form using cancellation contract form CC. So how does a seller cancel after waiting the proper amount of days? So you're going to check the applicable boxes at the top and bottom portion of the cancellation form. If the seller is canceling because a buyer refused to remove a contingency or take the applicable contractual action after being given a notice to perform, then the seller would check box 1A2 in section 1 of the cancellation, which is on page 1. This is what that looks like. So we're looking at page 1 of a cancellation agreement right here, and 1A. So this is saying this paragraph is used to cancel agreement by buyer or seller. So you're going to check who is proposing the cancellation. Is it the buyer or the seller? In this instance, we're talking about the seller proposing the cancellation, not proposing, but canceling. And what is the reason? So number 2 is the buyer has failed to remove the applicable contingency or take applicable contractual action after being given notice to perform. So on that notice to perform, you have checked they refused to remove their cancellation, or they refused to deposit earnest money, or they refused to provide verification of down payment. Those are the boxes you check on the notice to perform. And when that doesn't happen from the buyer, we gave them the notice to perform. It's been 2 days, and now we're sending the cancellation. How does the seller cancel after waiting the proper number of days? So if the seller is canceling because the buyer has failed to close escrow, after being given a demand to close, the seller will then check box 1A4 of the cancellation. So same page, section 1, instead of selecting A2, we're selecting A4, which is the other party has failed to close escrow and is being given a demand to close. So we gave them the demand to close, they're still refusing or don't have the ability to close escrow. It's been 2 days since the demand to close has been sent. Now we're canceling. May a seller cancel if a buyer removes contingencies first? So let's say you sent them the notice to perform, and the day after, the buyers removed the contingencies that they were being asked to perform on in that notice of buyer to perform. So the answer would be no. A buyer may remove contingencies prior to the cancellation. If prior to the seller canceling, the listing agent receives a contingency removal from the buyer as demanded, then in that case, the seller no longer has any right to cancel. Even if the seller were to attempt to cancel, the parties would remain in a binding contract. Cancellation is a unilateral act regardless of whether there is an open escrow. The 10 reasons for cancellation, as outlined previously, confer upon the seller a right to cancel unilaterally. So if, excuse me, if they have done this properly and gone through the proper steps, sent out the proper notices and everything, the seller can just send this cancellation over to escrow and say, hey, this is canceled, we're moving on. Whether the buyer agrees or not to it, doesn't really matter. The deal is canceled. And as long as it was done properly, it's going to be a legal cancellation from the seller. So relevant whether the buyer agrees to the cancellation as long as the seller has properly performed the current procedure. Excuse me. All right. Is cancellation effective if buyer will not sign cancellation of escrow? The answer is that the RPA provides the seller with a unilateral right to cancel the contract, and the seller may therefore cancel the contract without the buyer's consent. Escrow may require signatures from both parties to cancel the escrow, and this is going to be dependent on escrow's policy on how they handle this. But the fact of an escrow being open does not affect the validity of the seller's cancellation. The buyer's refusal to sign the bottom portion of the cancellation form does not preserve the buyer's right to buy or render the seller's cancellation effective or ineffective. So if you look at the cancellation form, it's 2 parts actually. The first page is who's sending the cancellation over and for what reason. The second is the disposition of the earnest money deposit. Now that's the part where things get a little sticky usually, is the maybe they don't agree upon what's happening with the earnest money deposit. And at that point it could get into a dispute on the earnest money. That doesn't mean the deal is still active. It has been canceled. And now we're just dealing with what happens with the earnest money. Is it getting released back to the buyer? Is the seller disputing that? Are they going to split it? What's going to happen? So that is the short presentation on that. Now I do have another document that I made if you want to take a look at it. Let me get out of here. Which is the cancellation procedure if we want to go a little more in depth in that. Let me share that screen. And it's a good time for questions too. So if anybody has questions on any of this stuff, throw them in the chat so we can go through it, or any scenarios that you might have. So let's just touch a little bit on going deeper into the steps of, I know I kind of, went fast on that. I gave you the 6 steps, but here they are a little more in depth. So how do you determine the day of acceptance? This comes up a lot too. So the very first step in checking the time frame is to figure out when acceptance of the contract occurred. This has a very particular meaning in the RPA. It is the day when the offer or final counteroffer is accepted in writing and delivered back and personally received by the other party, or the agent for the party. So personal receipt means a copy of the document, or as applicable, link to the document. The new version of the RPA does allow for links and things like that. They start referencing that kind of stuff now. Is in possession of the recipient party or authorized agent, or electronic copy of the document, or as applicable, link to the document has been sent to any of the designated electronic delivery addresses specified in the real estate broker section of the RPA, which I will show in just a minute as well. So for example, imagine the buyer makes an offer on Monday. Seller signs an acceptance of that offer on Tuesday, but the accepted offer is not delivered back to the buyer's agent until Wednesday. In this case, Wednesday is the day of acceptance, assuming the real estate broker section of the RPA is filled out with the agent's name. For purposes of counting the contract, that day, Wednesday, would be day 0, because that's when it was delivered back. The day of after acceptance, Thursday, is day 1. And this is how escrow counts the days as well. It's when it was delivered back. So how do you count the days after acceptance? As stated above, day of acceptance is day 0. The next day after is day 1. Days in the contract, aside from earnest money deposit, that is the only exception. Days means calendar days, unless otherwise specified. This means that you will then count every day, including Saturdays, Sundays, and holidays. However, the very last day of performance cannot be on a Saturday, Sunday, or holiday. So if the day to perform, meaning the day that the buyer was supposed to release whatever contingency, falls on a Saturday, you cannot have them perform on the Saturday. It actually needs to be on the next Monday following up. And that actually goes for the seller side too, on delivery of documents and stuff. If the day that the last day that the seller can deliver disclosures and everything to the buyer is on a Saturday, technically they have until the following Monday to perform on that, which sounds kind of silly, but that's how it works. So, check the buyer's compliance day. After determining the acceptance date and counting the days accordingly, check the provision of the contract that seller is relying on in demanding the buyer's performance. For example, if the seller is demanding that the buyer remove the inspection contingency, then the buyer must be given at least 17 days under paragraph 3L1, unless that was modified. So by default, all the contingency timelines are 17 days. Remember, the last day, if the last day is Saturday, Sunday, or holiday, then the seller cannot demand performance before that last day. The notice to perform can be delivered no earlier than 2 days before the expiration of the applicable time frame, and that's something that a lot of people don't know either. So if things aren't going well and the seller is really wanting to cancel this sale, and let's say they had a 10-day contingency period, you could actually deliver a notice to perform on day 8 if you want. No earlier than that, but you could deliver it on day 8. And then when the day to perform comes about, and let's say it is a weekday, and the 10th day is Monday through Friday, one of those days, you can go ahead and cancel then because you've already delivered the notice to perform. So, now you can't deliver the notice to perform sooner than 10 days from the performance date. So keep that in mind. But if you're really, I guess, being aggressive with making sure the buyer is performing, The earliest you can send that notice to perform is 2 days prior to the day of performance. So keep that in mind. That's a lot of people don't actually know that. So step 2, seller obligations. So again, this is my first question when someone calls me and says, can my seller cancel this sale? This is my first question is, has the seller delivered all disclosures? Seller should be in full compliance with all of seller obligations at the time the notice of buyer to perform is delivered. What this typically means in practice is that the seller has delivered all of the required disclosures and reports within 7 days per the contract. A seller who has not met that basic obligation but nonetheless demands that the buyer remove all contingencies is putting the cart before the horse. It's necessary to deliver all disclosures before buyer's obligation to remove inspection and disclosure contingencies arise. Thus, the seller's notice of buyer to perform is sent out before all disclosures have been made. It will likely be defective. The buyer may thus be able to challenge any subsequent cancellation based on that defective notice. The RPA specifies that where the seller has sent out disclosures, reports, or other information late, then the buyer will have an additional 5 days after receipt to remove contingencies if those 5 days go beyond the 17-day contingency period. So let's say seller is trying to get the buyer to perform, sending out the notice to perform, we're at the 17-day contingency period, and maybe the buyer says, you know what, you never provided whatever, the TDS, the NHD, the AVID, anything, and then you deliver it to the buyer. Well, now the buyer has another 5 days per the contract for them to review what you just sent them. So now you're just kicking this can down the road because the seller didn't fully perform in the first place. And we actually have a scenario going on with this right now where this happened. It's actually working out in the seller's favor, but yeah, be sure you deliver everything within those 7 days if you're on the listing side. NHDs, prelims, everything that the seller is going to provide needs to be provided in those 7 days so that you can assure that when you need to send a notice to perform, you can do it and it won't be defective. What's next? So has the seller allowed the buyer the right to conduct investigations? That is the other thing. It states in the contract how long you have access for. And it's right under the investigation contingency. The next one down says basically property access, and it's defaulted to 17 days as well. So has the seller allowed the buyer to do any and all inspections that they feel they need to do to satisfy themselves as to the condition of this home? Roof inspections, plumbing inspections, any of that all falls into that time frame, and the seller needs to allow the buyer to fully satisfy themselves as to the condition of the home. So that is a second part to, has the seller fully performed? Have they allowed the buyer the right to conduct investigations? You cannot use tenants in place as an excuse for this, which I see listing agents try and do sometimes. Oh, well, the tenants aren't going to allow access, this and that. Yes, with given proper notice, you can enter that home even with the tenants in there, and they need to allow that. So don't let that be a reason, or try and use that as a reason, and not let the buyer fully investigate the home to their satisfaction. That will also help ensure that there's not going to be post-closing claims, because if the seller didn't allow the buyer to fully investigate the home and they end up removing contingencies just because of pressure or whatever, and then post-closing things come up that they didn't know or they weren't allowed to investigate, for whatever reason, that can lead to a post-closing claim. So you want to instruct your sellers to allow the buyer full access to the house during that time frame in contract. So what else? Does the seller have to complete repairs before giving those buyer to perform? This question comes up a lot. Seller repairs are not required to be completed until prior to final verification, which is by default 5 days prior to close of escrow. So they have up until those 5 days prior to close of escrow to make the repairs. A common misconception among buyer's agents is that unless repairs are complete, then the inspection contingency need not be removed. We actually went over this last week, 2 weeks ago on the request for repairs webinar. However, under the terms of the RPA, seller repairs are not required to be completed until just prior to final verification. So this would typically not be a precondition to the buyer removing contingencies. The buyer does not remove contingencies by day 17. The seller can properly send over a demand to remove contingencies. We're assuming that this is 30-day escrow, despite the fact that the seller has yet to complete repairs. Step 3, filling out forms. So that's going to be your notice to perform or the demand to close. It must be correctly filled out, indicating the buyer has failed to do, and the seller must sign it. Can a contingency removal be used without a notice of buyer to perform? So use the notice of buyer to perform form. That's what that form is for. One common mistake is when a listing agent merely sends over the contingency removal form, Form CR, and demands that it be signed and returned. But the CR form is simply not a demand and does not qualify as a notice of buyer to perform. The listing agent needs to use the notice of the NBP form and should not attempt to substitute any other form as a demand. How should the notice be completed? I went over that on the last one as far as the cancellation form. Well, we could talk about the notice of buyer to perform. Check the correct boxes. So the notice to perform must specifically exactly what action is demanded. Failure to fill it out by not checking the correct boxes will make the demand pointless and defective. So if you're demanding that the buyer deposit earnest money, then you need to check that in the corrective actions. If you're demanding that they release investigation contingency, you need to check that exact box as well. You can check multiple boxes if there's multiple things that are being demanded, but you need to check the ones that apply. Do not write in a shorter specified time on the notice of buyer to perform. Another common mistake is for the listing agent to change the 2 days space to something less than 2 days. So do not write in 1 day or 48 hours. Neither of these times are equivalent of 2 days and could render the notice of buyer to perform defective. This time period is set in the contract under 14E. So the RPA references the notice of buyer to perform and gives them 2 days in the contract. So you've already agreed up front when you sign the listing agreement, or not the purchase agreement, when everybody came to an agreement on it, it's already in there that the timeline is 2 days for the notice of buyer to perform. So you can't then later on, when the buyer isn't performing, send one and say, I'm giving you 1 day to perform on this, because that's not what the agreement is. So the only time this box should be changed is if the time period in paragraph 14E has already been modified in the contract itself. So if during negotiations of the RPA and counteroffers, you make that notice to perform date be less than 2 days, that would be the only time that it would be valid. And the seller must sign the notice of buyer to perform and demand to close. This is a requirement of the contract as well. Step 4, delivery of the forms. So when the new RPA rolled out, was it last year? I think it was, the new form with the grid and all that stuff. They actually changed how delivery was done during that time, which I think made this so much better. So as defined, if you go to K in the RPA where it has all of the definitions, the definitions section of the contract, it talks about delivery of documents and what that means. So how can you deem them to be delivered nowadays? And basically, we're going by the mailbox rule now. So um, if you have properly filled out the broker section of the RPA, then if you send any and all documents to the designated email and or phone number that is listed in here, then it is deemed as received. So make sure you fill this part out. This is actually a really important part of the contract that gets skipped over a lot. Is it says right here, designated electronic delivery addresses, check all that apply. Email above, text to phone number above. And whatever email has been put in the contract right here, this is page 16 of the RPA, that is the designated delivery address. So if you send stuff there, then it's been delivered. Now, what happens a lot is you get transaction coordinators involved and things like that. And all of a sudden now you're sending stuff to a transaction coordinator. Technically, that's not being legally delivered. So if you're going to send stuff to the transaction coordinator, you also need to copy in the agent and their designated email and or text number as well. So that way there is no gray area as to if these things were delivered and when they were delivered. So definitely keep that in mind. And you may get pushback from listing agents saying, I send it to my TC, send it there, send it there. Don't get caught in that trap because you don't want there to be any dispute on when and where this was delivered and if it was properly delivered or not. So whatever email is here is the designated email. If it's an alternate email, then that needs to be checkbox right here and then type in that email address. For you listing agents out there, you also have to fill in section B, and you see right here, the boxes are left. You can't fill this in if you're on the buyer side. So when you are signing this RPA and filling in your information here, you also need to fill out and check these boxes, email above, text above, or if there's an alternate email, that's going to be the designated electronic delivery address. So be sure to fill that in as well if you're on the listing side. Step 5, counting the days. I went through that. The final day cannot be Saturday, Sunday, or a holiday. Just remember that it's going to go to the next business day. So count the days properly. You know, if you're delivering a notice to perform on a Saturday or something like that, or maybe a Thursday. Thursday is a tricky one because now you got to wait all the way until the next week to be able to actually cancel. So be mindful of counting the days. And then the last, the cancellation form. I already went through the cancellation a little bit, but make sure that they've waited the proper amount of days after sending the notice to perform or the demand to close escrow, that they've fully performed before doing that, that they cannot cancel if the buyer does remove the contingencies or does deposit that earnest money deposit or whatever that corrective action was. That removes their right to be able to cancel. And that's about it. So I went ahead and PDF'd this form right here. So if you guys ever need this cancellation procedure, I'm going to throw it in the online office. If you ever need to reference it and you're going through, you know, a contentious cancellation or potential cancellation of a contract. So, other than that, if you guys don't have any questions, hopefully that was a little clarity on seller cancellations, not buyer cancellations. This was focused on seller cancellations this time. So hopefully that was helpful. I don't see any questions, but always feel free to give me a call. If you're getting stuck in one of these, and I'm glad to help get you through it. Hopefully everybody has a great week, and we will talk to you soon.